Thank you very much, Gerald. And we continue now with Duncan Hall, responsible for the MMO division Northwest Europe.
Thank you very much. Good morning, everybody. My name's Duncan Hall. I look after Northwest Europe for Bilfinger. I'm 50 years old. I started off my career with ICI. I did 16 years with them. I then moved to an engineering business, which was acquired by Bilfinger back in 2007, and I've worked with Bilfinger since then, so that's 11 years. I look after the Northwest Europe division with my colleague Clive Kendall, who's also been in Bilfinger for a similar period of time. We look after Northwest Europe, decent revenues, second biggest in revenue from a Bilfinger perspective, and we split the region up into three areas that we look after. The countries are Norway, UK, Denmark, Belgium, Netherlands. How we operate it, to simplify this, is we operate it in offshore. So this is where the offshore division of Bilfinger is situated, looking after fabric maintenance in the North Sea. We have UK onshore, and then we have BeNe, Belgium and Netherlands. It's all about simplification, trying to get the message over to our customers of how we can do this simpler and better for them. When you see our industry split, this is where you see the dominance here of Ollie and gas. Don't know who Ollie is, but that is actually oil and gas. So we have a large dominance within there because that's the upstream side looked after in the North Sea. So we have 86% of our revenues are coming out of oil and gas and chemical and petrochemical, largely through the refinery sectors. In terms of how we operate in contract types, I don't know what's happened to these particular slides. We have a very similar split as we have with Gerald. We have 25% is lump sum, 25% is unit rates, and 50% is reimbursable. The lump sum elements are very similar to how Gerald described it, of where we look after the budgets for customers, but we can also change the work that's done because we're managing the work list for customers in those environments. The reimbursable environments also generally have incentives on them. So we will have key performance indicators that we have with customers, and we're very focused on those because that's where we can increase our margin in those reimbursable environments and deliver what the customer wants. That's what they want, and they're willing to pay us more money for it. Our retention rate is very high. Going backwards, we've got customers, Equinor, formerly Statoil, that we've worked with for 30, 40 years, and we'll be working with that customer, as Tom said, for at least another 15 years, as we have a new contract with them. So, I need to talk to you about the oil and gas market, because that's my main market. You may have noticed we had a bit of a dip a few years ago in the oil price. I'd be surprised if you didn't. That caused great challenges for customers and for suppliers. There was a 40% decline in lifting costs, reduction. Fantastic for the customers, bit of a challenge for us. We kept very profitable throughout all of that because we're a very agile offshore business. Low overheads, able to flex our numbers quickly because it needs to be a responsive market that we operate in. If you look at the sustainability of that North Sea market, if you go back 3 years, I think 90% of the businesses who are operating in the North Sea were break-even at $80 lifting cost. The lifting cost is now $40 on average. They're profitable, and we're seeing that, and they're making good money again. And we're seeing the backlog start to come through, so our maintenance work is increasing. We're seeing projects starting to move from ideas into sanction. So it's a positive environment. We're seeing more smaller and private investors coming into the North Sea market. Those guys don't come in those markets without seeing a profit. And they're looking at some different models, which I'll come on to in a minute in terms of how we operate. If we move forward a little bit then into what's that mean to the downstream business, petrochem hubs that we have in and around Belgium and Netherlands have a significant level of investment, certainly levels I've not seen for quite some time. And that comes from very, very efficient refineries in Rotterdam and in Antwerp, of which then the chemical and petrochemical hubs grow out of. And again, we are working on those refineries that will be in position for the next 10 to 15 years, because that's where the work is and the investment is going. So if we then look at some aspects of how are we responding to those market dynamics, and this obviously isn't the full area that we talk about. Offshore, we're the market leader in fabric maintenance, which is insulation scaffold painting offshore. We are 40% in the North Sea in that market. Our nearest competitor across the Dutch sector, across the Norwegian sector and UK sector is below 20%. What are we looking at doing to continue to grow? Actually, in the Dutch sector, we've got further to go, and that is an unconsolidated sector. UK offshore, Norway offshore, it's largely 3 suppliers, of which we're the largest. The Dutch sector is multiple suppliers, and we will consolidate that and increase our market share, and hence stay on top of that fabric maintenance supply base. We're also moving into what is called the second-tier engineering supply area, and we've recently won our first contract in that. This is because those private investors are looking at different ways of getting their engineering business done that are not reliant on the large engineering businesses and the large profits and overheads that are demanded from those. They want a more agile, a more customer-focused perspective, and we can bring that, and we're moving forward very nicely within that. Moving onshore, very high retention rate, again, with our customers. And how do we do this? It's a big challenge. When you're working with a customer for a long time, you generally look to extend your contract through negotiation rather than tender, because then it's at risk. So that means we need to keep driving efficiency, because when we extend a contract, a customer is generally looking to get something from us. So we will have to give him some reductions, some discounts. So we've got to continually drive our innovation and performance and efficiency through service and delivery innovation. And more recently, BMC, as Gerald was talking about, digitalization, as Franz will talk about, BCAP, all of these areas. This is actually now what the customer's talking to us about and really pulling us into wanting to have those as part of our delivery. As I look after the UK, apparently I'm obliged to talk about Brexit. I haven't got a clue what's going to happen. So please don't ask me that question or Tom. But what does it mean for the Bilfinger business in the UK? We've got a big business in the UK. We do over 350 million euro in revenue. But it's a local business. We've been in that, been in the UK now for over 10 years, and it's largely operates within the UK and with UK people. We have made a slight shift to our strategy in terms of growth, because the UK will continue to invest in businesses in the UK, no matter what happens with Brexit. And that is very much energy and utility infrastructure. So renewable energy, water distribution, electricity distribution, gas distribution is a growing market for us in the UK. And we have a number of long-term framework contracts to reflect that, which safeguards us against the economic shifts that might happen post-Brexit. Here is an example, as Tom talked about, though, about BTOP. And how do we manage difficult contracts? This is a special guest slide that you haven't got in your pack, because it's a recent one, a recent review we did of this particular contract, and it is sensitive to the customer. We've taken the customer name off, though. So this is a contract that we won fairly recently. We transitioned it at the start of 2016. And it takes you through a bit of a performance challenge that we have when we win a lot of contracts. When you win a contract, a customer is generally giving you that work for a reason. The main reason being you are saying you're going to do it for less cost than whoever's doing it at the moment. So that brings challenges. You've got to do things differently. But the first thing you need to do, which is reflected in here, is make sure that your safety and delivery performance is correct. If you don't have that, you cannot talk to the customer about either KPI improvements or changing things as we move forward. So the first thing we always need to do is get the safety and operational performance right. How do we do this? Before a contract goes in place, we put in a transition team. So we mobilize people even before we're doing work. And they start to get the customer prepared, get our people prepared, documentation, processes and systems. And then that transition team stays in place for the first 100 days of the contract and will take the customer through those. And one of the most important things they'll do from day one is start to measure performance. On this particular contract, if you've been studying these far too closely, here, this is our margin. Not a pleasant outlook. I didn't particularly enjoy discussing this with Mr. Patzak at the time. We were not doing as we predicted. So we had to come back. We brought in another task force, demobilised the transition team, because we needed a different view. Brought in task force 2 to go in and study what's going on here. We're not delivering this properly. We mobilised our BTOP team to go in there and work on what can we do ourselves to improve our efficiency. And we come up with a very simple framework for doing that in terms of behavioural actions and physical actions, locations of stores, so we can drive being more efficient, more hands-on tool times. But in this particular case, one of the big ones was the customer hadn't changed how they wished to do things. One of the key elements here was the customer needed to change how they package work, how they give us work, to enable us to do this in a more efficient and planned manner. And they weren't doing that. So we formulated the data, presented it to them, and established that there's a need for change. And that's very quickly then where you saw the improvement starting to happen. And we became profitable after 8 months of this contract. And we've maintained profitability since then, and we'll go forward and continue to increase that profitability. That comes largely from this one, which is productivity, where we started up here and we came down very quickly to improve that, and now we're below our target line. And that's the key element when you come to maintenance contracts based on unit rates, is we've got to have a robust system, of which we've got a tried and tested system to improve productivity and deliver profits after a certain amount of time post-transition. So, in summary, what's important? Understand what the customer wants. Generally, safety, delivery, and cost improvement. That's fundamental to what we do. Take shared ownership of the challenge. It's very difficult when you're in that tender process. You have to be quite robust with customers about, we need to do this together. You have a desire for change, we have a desire for change. And we need to get their ownership for their part in that, because we cannot do these things ourselves. We need the customers with us. And then most importantly, measure the performance. Data saves any need for an argument. If you have the data, it's just fact. This is what's happened. And BTOP enables us to have this data very clear, very simply, and present it to customers, and enables us to move forward better. So, Northwest Europe, what are we about? We've got solid markets, recovering, good investment going to continue happening in those oil and gas and petrochemical markets. We've got a very stable division. It's also very agile to what happens going forward. And we will continue to deliver the results that Bilfinger need. Thank you. I will now hand over to my colleague, Michael Lofferman, who very recently was in the UK with me, where we were, he's embarrassed now, where we were picking up our first contract documentation for the Hinkley Point Power Station at Bristol, which is very positive, and a joint effort between Northwest Europe and Engineering Technology.